The United States is watching something unprecedented unfold. Japan, Saudi Arabia, the UK, 16 of its closest allies, are offloading US Treasuries in massive amounts. Trillions of dollars in government debt are being sold off, raising a question Washington never wanted to answer. Is this the beginning of a financial unraveling? Foreign central banks once trusted US bonds as the safest place to store wealth. That trust is disappearing fast. Is this a coordinated global move? A sign of waning confidence in the US economy? And more importantly, what happens next? Stick around because this isn't just a headline. This could determine the future of global markets and your own financial security. For decades, US Treasuries were the gold standard of global finance. Countries stocked up on them, treating them like a financial safety net. But that safety net is now being ripped apart by some of America's strongest allies. Take Japan, the largest foreign holder of US debt. In the last year alone, Japan has sold off $225 billion worth of treasuries, its biggest reduction in over a decade, according to US Treasury Department data. The UK slashed $30 billion in holdings within months of Trump's election. Saudi Arabia, down by over $50 billion in just 2 years. Why? The reasons vary: soaring US debt, geopolitical tensions, and a fear that treasuries are becoming a risky bet. But is this just the start of something bigger? Donald Trump's return to the White House has sparked major uncertainty among international investors. His economic policies promise aggressive tariffs, isolationist trade moves, and potential Federal Reserve shakeups. Foreign governments don't like uncertainty. Markets react to it, and central banks hedge against it. In fact, after Trump's re-election, global bond markets saw some of their biggest sell-offs in years, with Japan and the UK leading the charge. Could it be that major economies are bracing for a volatile US economy under Trump 2.0? Here's a number that should send shivers down Wall Street's spine: $36 trillion. That's the size of the US national debt, and it's growing by $1 trillion every 100 days. Foreign nations once viewed US debt as a safe investment. But now, with government borrowing soaring to unsustainable levels, they see the risk. If the US prints more money to cover debts, that devalues the dollar. If the Federal Reserve raises interest rates, it makes borrowing even more expensive. Either way, foreign investors get squeezed. The message is clear. The US is losing control of its own financial system, and the world is noticing. China used to be the second largest holder of US debt, owning over $1.3 trillion in treasuries at its peak. Today, that number has plunged below $800 billion. Is China pulling back for economic reasons, or is this part of a larger financial strategy? Beijing has been shifting its reserves into gold, the yuan, and other assets, diversifying away from the US dollar. Trade wars, sanctions, and geopolitical tensions have only pushed China to accelerate this shift. If this trend continues, could we see a future where the Chinese yuan, not the US dollar, dominates global finance? Washington's reliance on financial sanctions has historically been a powerful tool, but it's now creating unintended consequences. The more the US weaponizes the dollar, the more targeted nations seek alternatives. Since 2022, Russia has nearly eliminated its dollar reserves, shifting over $140 billion into yuan and gold. China and Brazil have signed direct trade agreements bypassing the dollar entirely, while Saudi Arabia is now openly considering joining BRICS' alternative payment system. According to the IMF, the dollar's share of global reserves has dropped to 58%, the lowest in nearly 3 decades. Former US Treasury official Daniel Glazer warned, "Overuse of sanctions risks undermining the very leverage the US has in global finance. If the dollar loses its status as the go-to currency, the U.S. debt market could face unprecedented turmoil. China's Treasury holdings have plummeted to $767 billion, the lowest in 15 years, signaling a major shift in its financial strategy. While this reduces Beijing's exposure to U.S. debt, it also forces China to find new ways to store its massive foreign reserves. Analysts at J.P. Morgan note that a rapid sell-off could actually devalue China's remaining holdings, wiping out billions in reserves. Moreover, it risks strengthening the dollar as higher yields attract investors back to U.S. bonds. A disorderly Chinese exit from U.S. debt markets could create volatility that hurts China's own financial stability, warns Barry Eichengreen, a professor of economics at Berkeley. If the sell-off continues without a viable alternative, China might end up hurting itself just as much as Washington. Gold is emerging as the world's new safe haven, and central banks are making that clear. The World Gold Council reports that central bank gold purchases surged by 1,136 metric tons in 2023, the highest annual total since records began. The People's Bank of China alone added over 225 tons of gold to its reserves last year, reflecting a major shift away from dollar-denominated assets. Even Western allies like Germany and the Netherlands are repatriating gold to reduce reliance on U.S. financial markets. Former Federal Reserve economist Danielle DiMartino Booth explains, "Gold has no counterparty risk. Governments are realizing that treasuries tie them to U.S. policy decisions, while gold gives them true financial independence. If this trend continues, we could see a fundamental realignment of global reserve assets." BRICS has transformed from a loose economic bloc into a serious financial challenger to U.S. dominance. In 2023, the group expanded to include Saudi Arabia, Egypt, and the UAE, strengthening its control over global commodities. BRICS nations have now launched a cross-border payment system to bypass SWIFT and are ramping up trade settlements in local currencies. According to Goldman Sachs, BRICS nations now control over 40% of global oil supply and 25% of global GDP, giving them unprecedented economic leverage. Former IMF chief economist Maurice Obstfeld warns, "The more BRICS integrates its economies outside the dollar system, the harder it will be for the U.S. to maintain financial influence." If BRICS fully develops its own monetary framework, Washington could face a real challenge to its financial hegemony. For decades, Saudi Arabia upheld the petrodollar agreement, ensuring global oil sales remained priced in U.S. dollars. That era is fading. Riyadh recently signed a $50 billion energy deal with China, agreeing to accept yuan for oil transactions. This shift is monumental. Saudi Arabia exports over 1.7 million barrels per day to China, meaning hundreds of billions in trade could bypass the dollar system. HSBC analyst Paul McKell notes, "The petrodollar system underpinned demand for U.S. treasuries. If Saudi Arabia breaks that link, expect a domino effect. If oil giants like the UAE and Qatar follow suit, it could drastically reduce global demand for U.S. debt." The UK dumped $30 billion worth of treasuries in the months following Trump's 2024 victory, a move that spooked analysts. British officials haven't publicly commented on the sell-off, but market insiders believe it's driven by fears of a volatile economic landscape under Trump's policies. His threats to reshuffle the Federal Reserve, coupled with an aggressive stance on tariffs against Europe, have created massive uncertainty. The London-based Institute for Fiscal Studies warned that Trump's return could lead to unpredictable dollar fluctuations, hurting foreign investors. If traditional U.S. allies like the UK are offloading treasuries, it raises the question, how much confidence do they really have in America's long-term economic stability? The Federal Reserve has raised interest rates to 5.25%, its highest level in decades, to combat inflation. While this boosts Treasury yields, it also destabilizes the bond market. Higher yields make older Treasuries less valuable, leaving investors stuck with depreciating assets. The result: foreign holders like Japan, China, and Saudi Arabia are cutting their exposure to minimize risks. According to Bloomberg, foreign demand for long-term U.S. bonds has dropped 25% since 2021, with investors opting for shorter-term assets instead. Global funds are nervous about locking money into U.S. Treasuries when rate hikes could keep devaluing them, explains bond strategist Jeffrey Gundlach. If this trend accelerates, Washington could struggle to finance its ever-growing debt. U.S. financial dominance has always rested on two pillars: global faith in treasuries and the supremacy of the dollar. Both are now under serious pressure. The combination of record-high U.S. debt, shifting geopolitical alliances, and rising alternatives like BRICS are eroding confidence in America's economic leadership. The dollar's global reserve share has shrunk by 12% in just the last decade, while nations continue dumping treasuries at unprecedented rates. Some experts, like former World Bank economist Carmen Reinhart, argue that the U.S. will still be dominant, but it will no longer be the undisputed financial superpower. The real question is, what replaces it? If the global system fractures further, markets could face one of the biggest financial resets in modern history. This is no longer a theoretical debate, it's happening now. If major economies continue cutting ties with U.S. debt, we could be looking at a financial landscape radically different from anything seen before. The real question is, how will the U.S. respond? Will Washington fight to maintain its grip, or will it be forced to adapt to a world that's moving on? Drop your thoughts in the comments. Is this the start of a U.S. financial collapse, or just another bump in the road? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.